Welcome, ladies and gentlemen. Today is November 25th. We're going to go over the MENT Rotational Modeling System and the real estate sector analysis that I do every week. We're going to start off with the real estate sector, and very, very interesting. The government data came out. The new home sales spiked last month, and I'm not seeing it. I'm just not seeing it here. Now, maybe these were under contract. Maybe it's a data error. Maybe it's accumulation from like BlackRock and other larger firms. But understand that I am seeing, in fact, let me go back over here to this index to show you what's really going on in the market based on Realtor.com data. You can see here that the reduced count is up to 114%. That means that everything on the market and more is being reduced. Okay? Active listing count is shooting straight up, just like I told you. Median days on market is flatlining. That's because there's really not much activity in selling. So they're coming on the market and they're sitting on the market, and not a whole lot of buyers are out there buying. Price reduced share of market has inched higher. That's this light blue line. And we have to really take a look at the dynamics of the market, which is here in my modeling system. We are now at the lowest low level for the real price factor. Prices are down to minus 49, roughly minus 43% here. And a model market demand is at minus 37.67. That is a big difference from where we were back here. And remember, this is just early this year. So this is 1 year. Going back from 11/13/2021 to right now. We went from price factor as plus 50%, actually a little higher right here. And model market demand was up at 145, 150%. We're now at price factor as minus 43%. So that means we've turned around 180 degrees pretty much, folks. And demand has gone from 143% positive roughly to minus 37% to the downside. This is a big change, a huge change in the actual dynamics of the market. And I expect this to continue. I believe the real carnage has not hit yet. So now we take a look here at the pricing trends are moving downward. This is a Realtor.com data. Pricing trends have flattened out, and they've actually started to move downward. Price reduction activity is right here. Now, why hasn't pricing trends shown up here if reductions are so high? Because reductions are really only 2, 3, 4, 5% of actual market, and that is reflected here throughout 2022. You can see we were positive here. In late 2021, we went negative here. This level is minus 20%. So this is basically 5, 6, 7%. This is about 10% negative, and now we're dropping back into negative pricing structure. Okay, so it is happening. Inventory is skyrocketing. The number of active listings are now up to close to 7.5%. And we're now looking at price reductions shooting higher, about to go above 100% again, and about to really start to skyrocket, whereas new listing counts are at the highest level ever. Like I told you, new listing count change is increasing, and new listing share of market is increasing as well. Next, we have the heat rank. Heat rank has flattened out in negative territory, so the market is, think of it as not hot. It's actually moderately weak. Not like this 2021 area, but we're getting into this flatline area and still in weaker trending, have been for the past 6, 7 months. The tightness rank, which is a measure of, how tight the market is. Think of it as homes come on the market, homes get sold, and they go off market. That would be up here when we're starting to see a lot of activity. Right now, we're at the lowest tightness index that we've seen over the past 2 years. And that means that homes are coming on the market and they're sitting on the market. There is no activity going on. They are not being sold. They are not entering into contract. The market is really the bottom is falling out. Inventory strength is at the lowest level we've seen in 2 years as well. It did get a little blip back up to the upside. I think this was a decrease in interest rates and certain people buying, but you can see overall negative heat rank, negative price trending, negative tightness, negative inventory strength, and seller desperation moved up 1.1% last week. That means that sellers are getting a little bit more desperate, but not showing any signs of extreme desperate activity. Okay, that's another chart. So now we're going to go over to the MENT Rotational Modeling System. The MENT Rotational Modeling System was updated today. I figured I would update it real quickly to show you what's going on. This updates at the end of the month. So this is done on a monthly basis, so that we'll wait for that to update. But the data itself is showing very clearly that the markets have stalled. They're in a sideways trend. There is no change to our allocation. There is no change to daily, weekly trending. Nothing is really altered. We're still holding on to a large amount of cash. We have our hedge at 25% metals and nothing into bonds. Alternately, we have 10% cash, 90% cash, 10% stocks, 0% bonds. The markets are flattening. Watch my custom index video to show you that we're in kind of a nebulous sideways melt up trend, I believe. A very fragile market right now. Could actually break to the upside over the next couple of weeks, or could actually revert back lower again. And that's something you need to be aware of. We've seen this kind of a early stage Christmas Santa rally. We've seen some accumulation. It looks like traders are starting to re-engage in the market, but we are not seeing consumers in the market. We are not seeing follow through and momentum in this market right now. We've reached upward channeling, and it's a very dangerous period to be going all in on one direction or another. I would recommend that you stay safely, securely away from risk factors right now and wait this thing out. I'm thinking now that we may actually see more of a late year or early 2023 trend change. We may see some accumulation, but we're not seeing anything but sideways, very fragile market activity right now. Okay, and next we have the current status of the MENT Rotational Modeling System. Weekly is still bullish, daily is still bearish. Nothing has changed. The only thing that's changed is that our position is now negative 0.60 on our consolidated position. We're still holding our own, ladies and gentlemen. If this is where we're at over the past couple of weeks and we have a net loss of 0.60, we're doing okay. And that's what I want you to be aware of. We're doing okay in this position. I will tell you that things could change dramatically over the next couple of weeks. I expect the markets to melt upward. We will see how that plays out, and we'll go from there. That's the update right now. Really, nothing has changed. Just a moderate amount of accumulation in the markets. Our bearish position is weakening. We're very close to potentially changing this into bullish trending, but I need you to understand that we have yet to see any real big change. Markets are just flattening out into a sideways, consolidated, almost a pennant type of formation, and we have no real major change with the long-term rotational modeling system. Still looks very nice over here when you get right down to it. In fact, I was looking at something the other day. Which one was it? It wasn't BlackRock. It was Bloomberg, I think it was. Bloomberg hedge funds for the year look ugly. Minus 20, minus 30, in some cases minus 40% for this year. And so far for this year, the MENT Rotational Modeling System has lost 6.2%, and that's going to be updated here in another couple of days. The reality is, if you don't know what you're doing and you can't pull away from market risks at appropriate times, risks can really chew you up. I mean, I don't know how anybody can withstand a 40%, 30% downturn when the major markets, pulled down 22, 24%. Yeah, I get it. ARK fell 67%. You know, the marijuana sector fell 80%. Other sectors have fallen dramatically. But, you know, the whole idea is you move your capital away from risks and you try to protect against this. Preservation of capital is like number one for most traders. So I'm just flabbergasted at the fact that a lot of these hedge funds at the end of this year, if the market flattens out right now, you're going to be looking at some really ugly hedge fund numbers, you know, minus 30, 40, 50, 60%. I read one company that had lost 71% of clients' capital, and we're predicting to be able to pull it back. I mean, do you realize you've got to see a 200% rally from a minus 71% decline just to get back to break even? That's really should be a lesson to everyone, is you're better off moving away from risk into cash like I told everyone to do back in July, August, September of 2021 when the markets were still going up. I was telling my clients and my followers to pull assets, move to cash. In fact, in July, I think it was, June and July, I told everyone to get to 55 to 65% cash. And in August, September, October, I was telling everyone to get 80, 85% into cash. I was telling you to lock in these gains, get away from the risk, and get ready for what's coming next. Now we've been comfortably sitting 90% cash for the most part the past 6, 7, 8 months. And I'm still telling you, stay away from risk. When the timing's right, we'll get back into it, because this is what the strategies, my strategies, are designed to do. They are designed to preserve capital, trade efficiently, and trade only when the markets are actually telling us it's opportunistic to trade. All right, guys, share this with your friends. Tell them what I do. Help me spread the word so that I can try to help more people. Okay? I really appreciate it. On to the next video.